We appreciate you joining us today here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates, 419-794-3030. Just by tuning in, joining us today, you're taking your retirement seriously. The next step is putting a plan together for you personally, 419-794-3030. Or go to the website, arhq.com. Some think the market is hanging in there during some challenging economic conditions, but wealth manager Shannon Sakosha tells CNBC,
well, there's certainly some risks ahead of us. We obviously have the UAW strike, certainly could have some meaningful impacts, not only in sort of near-term GDP, but also longer term. We also have what's happening in Washington. We averted the shutdown earlier this year. We're talking about the potential for the consumer to start to slow down. We're seeing the resumption of student loan payments. So there's certainly a lot, even outside of market technicals, to create some volatility.
All these factors in play, is this enough to stay cautious for now, or are there some opportunities in the market?
Well, I think there's always opportunities in the market if you're taking a look at understanding how it goes and how the market works with being an auction. The thing is I would say, for younger workers that are out there, so anybody, that has more than 10 years for retirement time, don't worry about the daily news. In fact, one of the interviews that I did with Dr. Getzman from Yale is he did a 20-year study about people who watched the news and the financial decisions that they made. Those people who watched the daily news ended up making more poor decisions than folks who did not watch, constant financial news. So again, if you're 10 years or longer, turn off the daily news, continue to contribute towards your financial independence, and don't worry so much about today or tomorrow. Now, for those of you that are, within 10 years of retirement time, what I would encourage you to do, if you're going to need the money in the short term, because of the fact that we've had a strong rally in the market over the last, several months or year, now's a great time to fill up the next 3 to 5 years worth of your money. I met a couple just recently that are in that exact same situation, recently retired, probably going to need the money sometime in the next couple of years. They had all of their money in what's called a target date retirement account. And so in that target date retirement account, the mutual fund diversifies their money between equities and bonds. And generally speaking, as the retirement date gets closer, the more increase in fixed income bonds in a portfolio. The challenge about that is stocks and bonds are both investments that have risk. It's both investments that have volatility, and we saw that a lot in 2022. When you looked at the portfolio, we did a risk analysis, and in the risk analysis, it showed he had a risk score of 60 out of 100. So it's still, again, to me, it's going like 60 miles an hour. And, if you get into an automobile accident at 60 miles an hour, it very well could be a deadly accident. But because of the fact that we have fixed interest rates significantly higher today than where they were a year ago, I showed them how to take some money out of the bond part of the portfolio, put it in some fixed investments. Now, what that would do is that would give them a plan B. Mm-hmm. So if equities unfortunately perform poorly over the next 3 to 5 years, they have money in investments that were not subject to stock and bond market risk.
Sure.
They could pull off of that instead of being forced into a situation to sell off their bond markets at a temporary decline. And in addition to that, because of the fact that they put their money in investments that were not subject to stock and bond market risk, it took their risk score down from a 60 to a 30. And I don't know about you. I mean, if you think about Cedar Point, my kids aren't big fans of roller coaster rides, but a lot of the times when I talk to people, as you get older in life, you don't want as much of those ups and downs within Wall Street. So a 60-level portfolio is going to have much more ups and downs than a 30-level portfolio.
Sure.
So how you allocate your investments can make a big difference. And it can make a difference right now about how cautious should you be in the stock market. At the same time, there's some really good opportunities. I had another conversation with a client last week, and we had some money that was set aside on a buy on a dip opportunity. Now, but in July, the 31st of July, the markets in general have been kind of selling off for the last couple of months. And, the market had created a buying opportunity, which is what had led us to this conversation. What we were able to do is we were able to take an option on the market in a protected equity strategy. This is in an exchange traded fund. So you can ask us about our protected equity portfolio or go on YouTube and see a video about it. But what it does is it limits the downside risk overall between now and a year from now, and the fact that we could put a big majority of the losses to another investor if the market continues to go down. But between now and a year later, if the market goes up, it allows them to participate if the market has some good growth. So he was able to take some money and look at, being able to buy on a dip that we have here in this market. So again, having a predetermined game plan that talks about when to sell, when the market rallies, and when to buy is helping you do the opposite of what the average investor does. So the average investor, again, gets greedy when the market goes up and they chase those hot stocks, and they get fearful and they sell off when the market goes down. We want to help you kind of run that fire safety drill and know about strategies ahead of time so you don't have that particular situation, especially, again, when you're in that time frame. When we look at there's opportunities within the market, if we look at the S&P 500 index, a lion's share of the market returns this year have been driven by 7 out of 500 stocks. So finding opportunities is looking at the other 493 stocks in the S&P 500 index. We use a defined investment methodology, so we can screen stocks for cash rich. We can look for stocks that are low debt. We can look for stocks that have great return on equity. Then we can look at the fundamentals of those stocks and be able to make a more intelligent decision about, investing in opportunities in this marketplace on where we think, 3, 5, or 10 years from now has some good growth potential. And I think if you look at some of our portfolios like our Capital Strength or our Daily Essential, there really are some good opportunities for, again, some of that more long-term money. So the answer is, how cautious should you be in this market? It depends upon your time frame. It depends upon when you need the money. And then if you have a little bit more longer time frame, taking a sniper shot approach to figure out where there are those opportunities in the market can help you out. If you're not sure if you're positioned correctly, that's exactly what I'd love to have a conversation about. I can provide you with an independent portfolio analysis. We can dive deep into your portfolio and we can look for opportunities to make sure that, one, every dollar is working as hard as it possibly can, in our opinion. But two, also, are you in the right place to benefit whether the market goes up or down? That's what we can talk to you about. And again, I love doing that for our radio show listeners. If you're one of the 5 callers that calls us up, just call me up, say, Nolan, I want that independent portfolio analysis. I'll put that together for you and give you my professional advice and guide back about, how cautious you should be in this market.
I'm reminded of 2 quotes in regards to the market. Warren Buffett kind of encapsulated what you said there. You want to be fearful when others are being greedy. You want to be greedy when other people are being fearful. It makes sense. Putting it to paper, a little more difficult. And the other one is perhaps not as financially savvy an investor as Warren Buffett, but Kenny Rogers. You got to know when to hold them. You got to know when to fold them. If you need help with that, again, that is where that independent portfolio analysis really comes into play. Be one of the first 5 callers, 419-794-3030.